Got it. All right, yeah. So I am going to, again, my name is Shelly Miles. I am a commercial mortgage broker. Together with my husband, Jerry Miles, he'll tell you a little bit about our business and our family, and he'll do some introductions to the Multifamily Freedom Chasers ecosystem. And then we will go through the current debt market update, which is we got some good news. And then we have our main topic, which we'll be talking about different ways to finance your multifamily deals. And then we'll have a section for open Q&A. With that, Jerry, I'm going to hand it over to you. And yeah.
All right, great. Welcome everybody. I am Jerry Miles, Shelly's husband, and go ahead and hit the next page there. We were having some technical difficulties before we got signed on here, and I'm not able to share my screen or anything, so she's having to do it all tonight. So, but I want to introduce you all, first of all, to the Multifamily Freedom Chasers ecosystem here. These first three guys you see, Trevor, Marcel, and Victor, are the guys that kind of put everything together and I guess the brains behind the operation and just kind of put this whole thing together for everybody to kind of gel and to have a community to go to and to be supported by. So Sunday nights, every Sunday night we have a call. They call it the activation call, and I've had some pretty big people in there here over the last few weeks. Got another big one coming next Sunday. Robert Martinez is, I guess he was National Apartment Owner of the Year 2 years in a row, and is a big guy in the space. Mondays we have broker calls with Peter St. Martin and Eddie. They get on and make live calls to brokers and encourage other people to get on as well on the calls, and just helping people to get out of their shell and to start taking action. Tuesday nights at 8, we got napkin underwriting, going through all the details of the deals, and these multifamily deals are businesses in themselves. Each one is its own business, and they teach you how to evaluate values, value add, just all the different things with the underwriting. So, and then every Wednesday night, you've got us. We're on here. We do a quick, kind of just a quick current debt market situations that we're in. The debt market's changing daily currently, and and then we usually have a special topic. This week's topic is different ways to fund your multifamily deals. And we're just going to go through kind of some of the different programs and what's out there and available. So if you guys haven't plugged into the Freedom Chasers community, I'm sure we'll put a link in the chat for that. You can join the community on Facebook, and you'll be able to see all the different events and everything that's going on. So if you're wanting to invest in multifamily and or just any type of real estate, it's a good community to be a part of. So encourage everybody to do that. You can go ahead and hit the next slide when you get a chance.
I just put the link in the chat. Can everybody hear me still?
Okay, cool.
Okay. I just put the link in the chat for the Freedom Chasers Facebook link. If you're already a Freedom chaser, put 1 in the chat. Just 1 person, 2 person. Okay.
All right. Well, cool.
If you are new to our Zoom call, put 2 in the chat. Nice. Awesome.
Nice.
Go ahead and join that Freedom Chaser Zoom, guys. He just explained all the good stuff you guys get for free on there. There's a lot of benefit to joining that group. Here's the link again. Thank you. Go
And
ahead.
that's the cool thing. I would like to just add something else to that with the Freedom Chasers community is all the education and the time and everything that people put into this community is all 100% free. I'm sure some of you guys are a part of other masterminds and things that have a big cost to them. We've been a part of several different ones. Right now, we're in Grant Cardone's real estate club, and it's 25 grand a year. The cool thing here with this one is it's 100% free. And these are things that you won't. These are things you won't learn in college. These are things that you know I know Marcel and Victor and Trevor are all down in Houston this weekend at another mastermind, or this week they're at another mastermind learning, and they're going to come back and bring you that information and to this community here, and it's free of charge for the community. We're really trying to build a community, and we're working on putting together a big group of people that that we can all work together and grow with and push each other up and raise each other up. So don't take that lightly. Like I said, it's 25 grand to be in Grant Cardone's real estate club. And there's a lot of value there, but there's a lot of value here. But just because it's free, don't take advantage of that, and don't treat it lightly. So just wanted to add that real quick. But yeah, like my wife here said before, I'm Jerry. She is Shelly. We're commercial mortgage brokers. We started Adventure Commercial Capital right about 2 months before COVID hit, and we are the founders. We're brokers, so we have many different sources and things that we get our money for deals for people like you. Um, and just to give you a little history on how we got into this, we've run a commercial roofing business for the last 20 years. Um, Started out with just a truck and some tools and subcontracting work for Home Depot. And over the years, we've gotten into now we now do a lot of government housing. Mostly commercial, new construction, shopping centers, those types of things. So we've been able to grow a big business there, and it's supported us well. But through that process, we started investing in real estate. Um, Kind of a long story short, we ran into some commercial mortgage people and some commercial loan brokers that weren't real honest with us, were overcharging us, and just didn't treat us real well, and weren't honest people. And I told my wife, it's been probably 7 or 8 years ago. I told her, she probably heard me back then, or remembers me telling her back then, I think we could do this business, and we could do it better than these guys are doing, and we could treat people fairly, and be a good service to people, and it could be a good business for us as well. And so we did that right as COVID hit. So we've had a pretty big storm to weather there. We've gotten through that, and now as far as the current debt market goes, we've got another storm that we're in the middle of with the rising interest rates. So, but we're going to weather that one, and you guys are going to weather that one, and we're all going to come out on top. So, um, but in the picture, you got me and my wife, and Jordan and JJ, and also on the call here, our other son Riley, and his wife Lauren. I saw her sign in as well. So, um, but that is us. You can go ahead and flip the page. Just something here, you all can take pictures or screenshots, whatever you want to do, write it down. That phone number right there is my cell phone, and the email is mine and Shelly's emails. So that is the best way to get a hold of us. Um, any questions, we're free to talk. It doesn't cost any money to give us a call. We make money when deals gets closed. We don't make money for the education on these calls. We don't get money for any of that stuff. We make money as you guys are making money, and as you're closing deals or you're refinancing properties, those things are going on. When business is getting done, we make money. So, but we're here. We're here to educate. We're here, just to be of service. So, did everybody? I see somebody said they didn't see a number. But go back a page there to right there. That 859-835-4513 is my phone number. So, yep. Okay, cool. Go ahead and move on to the next one. And I want to encourage everybody to in the chat, tell us who you are. If you want to step on stage here and introduce yourselves, tell us who you are, and that take about a minute apiece.
I see JJ here, and then I saw Edward had raised his hand. I don't know where he went.
Yeah, go ahead and raise your hand, and we'll call on you. I actually cannot see that on my screen.
There he is.
Oh, okay.
All right, go ahead. Go ahead, Edward.
So I just had a quick one that a question that if you guys have a plan to answer for, I'll wait. But a question I eventually want to answer would be, what do you look for when people are bringing a deal to you? What would be like the proper way to do that? Just so that everyone knows, like, okay, yeah. I need XYZ, and I think I'm under arrest. One more question in addition to that would be, when is the best time to bring it to your attention? I think those are the two big questions.
Yeah, we will get to that towards the end. We've got a slide for that, and we'll tell you how to do that. But if you want to introduce yourself, go ahead and do it real quick while you got the stage.
Sure. Yep. As some of you may recognize me, I look a little different now because it's a little earlier, but I do the underwriting calls every Tuesday. I with Eddie as well. So yeah, my superpower is underwriting. Love this community. Love what you guys are about to share with us. I'm very excited, and I'm excited to just connect with everyone. JJ, thank you for putting your YouTube channel, because when I grow up, I want a YouTube channel like yours. I just scroll through and I'm like, it's like you're doing fun stuff. I'm like, your videos are cool. Now I have to spend the rest of my night watching them. So thanks. You owe me my Wednesday night back. But keep it up. Thank you guys.
All right, cool. Thanks, Edward. All right. All right, Robert, go ahead.
Are you going to put me on the spot? Nice. No,
go right ahead. I saw your hand up.
All right. My name is Robert Dodd. I'm up in Minnesota. I am a broker relations specialist working with a team of owners out of Texas. And I can personally vouch for the quality of the work from Adventure Commercial Capital. I'm just an average person, and they gave me their time. They got me a debt quote, on a property that I certainly didn't have the net worth to take down myself. But, join a team. This ecosystem is the exact place to start. And I want to thank the Miles family for contributing to the ecosystem, because this is a very important topic. So thank you all.
Awesome. Thanks, Robert.
JJ's next.
All right, go ahead, JJ. I see your hand up.
Hi, guys. My name is JJ Miles. I'm 16 years old, and I've been getting on these calls because I want to get loaded. And I have a YouTube channel here, and go subscribe to it. It's in the link in the description. And if you guys want to connect with me, I'll also put my Instagram in the chat. It's on my name, actually. And yeah, that's pretty much it.
Cool. Thanks, JJ. Yeah. And JJ had an exciting day here. This week. Had a video he posted 2 days ago that got 16,000 views.
Yeah.
And about
across all platforms. It was pretty crazy.
Yeah. So he was excited. So, but yeah, and
We've
I
got,
see, go ahead.
Mercy,
Yeah. Marcy.
Marcy, sorry, Mercy.
Yeah.
Your audio's off.
Okay, now is it?
You're
Okay,
good. I can hear you now.
Hey, there you go.
I am actually in Freedom Chasers. I haven't been able to attend a lot of things. I'm also sub 2 and Gator.
All right.
And I've been starting the real estate since September, April. And I'm right now jumping into a project with a partner at the mobile home park in Florida and have absolutely no idea what I'm doing. Not completely, but
Yeah.
didn't expect that to happen. And if it does, it'll be my first deal of any kind.
Awesome.
Well, you're in the
Awesome.
right place. I mean, joining
Yeah.
the Freedom Chasers ecosystem, you'll get a lot of information and learn a lot through that. So
And I'm really excited about this because, I mean, we have a private lender I just don't know if they're being fair and stuff. So
Yeah.
I'm excited.
okay,
Yeah. Cool.
cool. Glad to have
Good.
you.
Good to have you here, Marcy.
Thank you.
All right. Well, let's go ahead and move on to the next slide.
I see Robert's hand is still up. Is your hand still up, Robert, or do you have another share? Okay, maybe he's not there.
Yeah.
Okay, we can go ahead and move on.
Okay. I just saw Edward's hand. Let's go ahead and ask Edward to unmute. And go ahead, Edward. You'll be the last one.
Yes. This is Edward Tunde,
Yeah.
located in tri-state area. So we have a strong general contracting business. So if anybody is out there buying this apartment building and then you need a reliable contractor, so please have us in mind and then contact us. We can move pretty quick and then get stuff done. So customer satisfaction is the name of our game.
Awesome.
Thank you.
Awesome.
Thanks, Edward.
Yeah. Yeah. And
Put your information
will-
in the chat.
yeah. And I will vouch for Edward and say that anything he says that he will do. And that if you're going to hire somebody and you're looking for somebody trustworthy, give Edward a call for sure.
Awesome. We have time for one more. Manny.
Okay, one more. Go ahead, Manny.
Hey, good evening. My name is Manny. I have a W-2. I'm an IT manager. I've been in real estate for about 4 years. I'm also a licensed agent in the state of Florida. I've done 2 flips. I have a property that I rent out, short-term rental in Jensen Beach. And I recently purchased my first multifamily property in Daytona Beach that I'm rehabbing and hoping to get it rented by the end of March. And I'm just looking to connect with people, learn about the multifamily game more, and really grow and scale. So I can purchase 2 to 3 more, small multifamilies 1 through 4, and hopefully by next year be ready to start purchasing more of the larger multifamily, 8, 16, 32 units.
Awesome. I like to hear people getting things done. That's good. Go ahead and so there's our contact info again. Go ahead and move on to the next one. All right. So current debt market update. The Fed rates, they haven't changed much since the last time we got together. A lot of the lenders, like the government-based lenders and things, when you see this Fed rate of like 4.25 to 4.5, you usually add like 1 to 1.5% to that, and that's what your rates are going to end up being like when you're looking at your agency debt and things like that. The rates are up over the last I guess since the fall. We've kind of doubled interest rates since January to January. So that's an issue. You know, I don't think people realize that aren't in this business don't realize what it's done to this business as far as, um, you know, how we're, you know, if you know, just a simple example, if you were able to afford $1 million mortgage last year, this year it's like, you know, $600,000 mortgage you can afford. You know, and that's what's happened. So because of that, you know, we got some areas where housing prices are starting to fall. I think they were saying Austin, Texas on Bloomberg this morning is down 15%. You know, the housing values are down about 15%, you know, in the last couple months. You know, and we're going to see more of that. You know, I can't picture them, you know, all the numbers are getting better as far as the inflation and all that we talked about on our last call. Um, you know, but you know, it's getting a little better, but it's not back to where they want it. They're wanted down and around the 2% range, and we're still up in the sixes. So they're going to keep on with these rate hikes. They're going to keep, you know, the rates are going to stay high for a while until, you know, the last thing that the Fed wants is to drop rates and then inflation jumps up again. You know, they've already started this turn down and they're going to keep it turning, I believe. You know, some of the experts, you know, Grant Cardone says that he thinks the rates are going to fall towards the end of the year. You know, he's kind of on his own with that one. Most people think they're going to stick around where they're at or maybe go up a couple, you know, a quarter point or half point. But, you know, when we're looking at like what my lenders are saying and doing, you know, us as brokers, we have a lot of different lenders we deal with. You know, and you know, the lenders are kind of a mixed bag. You know, some of them are very optimistic about the future and they're going ahead and they're making loans and they're trying to keep their spreads down. You know, when you're looking at the Fed and so forth, they're trying to keep that difference between their rate and that Fed rate and things. They're trying to keep the spread smaller. Other ones are getting more worried. You know, I had one recently, you know, about 2 weeks ago now that said we're not going to lock in a rate until closing. And they said, and when closing happens, we'll be 4 points over the Fed rate. And so they were looking at, you know, lending on I think it was a 16 unit apartment building, and they were going to be about a 8.25 or something along those lines is what they were looking at being. But they were nervous about locking in the rate. So, you know, not all of them are that way. You know, we've been able to give out some good rates here recently. Our, you know, on the next slide, I'll show you where our agency debt and things is right now, and those have actually gotten better. You know, things like bridge lending and stuff, that the bridge lending has gotten worse. I had a bridge lender that quoted a deal for me. I didn't even quote it to the customer because I was embarrassed to, but the bridge lender quoted me 14% on a deal this week. So I went to another bridge lender, and I actually couldn't find another bridge lender that even wanted to do the deal. But you know, I just told them, you know, if the lender is this worried about it and all the lenders are this worried about it, you know, you use the lenders as a guide on what you should be doing and just run away from this deal, you know. So you know, the lenders are your partners and your friends on these deals. So when a lender is worried about lending on it, you know, maybe you need to take a little closer look as well, because you know, they look at a lot more deals than we do. So but here's the first slide. Here is the agency. When you're talking agency debt, it is the Freddie Mac, Fannie Mae loans. And what we're looking at here is the small balance programs. The Freddie small balance is 1.5 to 7.5. You know, loan size as far as million, 1.5 million to 7.5 million, and that is your small balance. You know, Freddie, and then Fannie goes 2 to 6 million for the small balance. So you know, when these rates have gone down significantly since the last time we had one of these Zooms on the small balance side, and I'll show you why here in just a minute. But these used to be, 5 3/4 to 6 something. 2 weeks ago when the new numbers came out, this is what we were ending up with. So go ahead and move to the next slide. And as you can see, these are the conventional programs for Freddie and Fannie, 6 million plus, 7.5 million plus. They don't really have a, you see that, Anthony, that's true. If the lender is worried, there's a reason you had to run. But you can see the rates are a little better on the conventional, not much, a little bit. And that's the banks like doing bigger deals. When you get a bigger deal, generally the guys that can close a bigger deal are more, experienced. They're going to have a better team. They're going to be able to manage the deal better. It's going to have more cash flow. It's going to have more income, so you can hire better help, and you can hire better maintenance guy. You can hire a better manager. All those things. So when you're looking at underwriting deals, know that the better the property, the more income, the more stable, the better everything is going to be on the lending side. So going to the next one. Once again, I'm usually clicking through these myself, but for some reason our computers weren't cooperating. We were scrambling a little bit as we were getting started. So, but right here, this statement here came, from one of my Fannie Freddie lenders. I've got 3 different sources that I go to for Freddie and Fannie debt. And because of that, I feel like I can be more competitive than a lot of than a lot of the lending houses or the mortgage companies, because, well, just an example, I had one recently. I gave someone a soft quote on a deal. And I was at, I quoted them at 6% on, I think it was a $7 million loan. And it was, for Freddie Fannie, it was through it was a Fannie program. And I quoted 6%. Well, I have one lender that says they specialize in the smaller balance. And so I was like, well, okay, I'm going to go to them, see what they can do on this. And when they came back with numbers, my customer was like best and final of two different people fighting over a property. And so I was trying to get hard numbers for them. And when my lender came back, they were at 7%. And so I was like, oh my gosh, I've messed up and I've got this guy down the wrong road. Well, I just turned around and I went to my other, one of my other Freddie and Fannie lenders that I go through, and they came in at like 5.6 and better than what I quoted originally, and everybody was happy. So, that's the value that we have, then we can provide, because not all Freddie and Fannie lenders are all going to quote the same things. They're going to quote a little bit higher, some of them, maybe because they don't have the pool or they're not doing as much as the other guy, and they might get better rates directly from them, or they might be adding some points in the spread there to make a little more money on the deal. You just never know what it is, but we can shop them around and get the best options for everybody. But this right here, Fannie and Freddie have come out recently and said they will lean in on deals that help them meet their 5 to 50 unit goals. The 2023 lending cap goal for each of them is to finance roughly $2.5 billion and 18,000 units in this space. So if you have a 5 to 50 unit property, now could be a great time to look at financing options. Other factors that could impact pricing include market, sponsorship strength, loan size, leverage, and DSCR. And it is a very fluid market these days, more than ever. So these 5 to 50 unit deals, Freddie and Fannie, they're mission driven. They were put together through Congress to be able to fund these things to provide affordable housing for the country. So when they come out and they say, we're going to lend on these types of deals, this is what we're looking for, you know, that just lets you know that you bring deals to them like this, they're going to be fighting to try to get deals done. So, all right, so we'll go ahead and get on with our topic of the night. Topic of the night is different ways to finance multifamily. And we're just going to go through some of the
Hey.
different programs.
Can I say something real quick?
Yeah, go
Are
ahead.
you guys
go ahead.
finding this information good, important? Let me know in the chat if you guys think this is great information so far. Right. And now we're going to get into the main topic. I want you guys to help me out here. I want you guys to take a screenshot or a picture of this Zoom call. We have 50 something people on here right now, 52 people on here. I want to get this maxed out to 100 because people desperately need this information before they go through deals, because I can't tell you how many times deals like this have fallen through because they refuse to come to us and keep us in the loop. And they would go through all the underwriting and stuff and just have no clue about the debt market. Take a screenshot, a picture of this, and post it in Freedom Chasers Facebook page or wherever, and share it so people can join. Tell them we're live. Thank you, guys.
Yep, awesome. Yeah. So yeah, we're going to go through just kind of some of the different programs here that are available to fund multifamily. First one is really my favorite, and that's the Freddie Fannie. It's a government program. Currently, they've got the best rates and terms. From the time that you get due diligence done and you're ready to move on these deals, we can get them closed 45 to 60 days. That's pending. When I say that, that's pending. If when I go to a borrower, whenever I'm going and working on these deals, I'll have somebody that inevitably wants to get done quickly, and we start going back and forth. There's a lot of paperwork exchanged and things, and it'll be sometimes 2 and 3 days between emails with them providing docs that I need. And then at the end they said, you said it would be 30 days and it was 40 days or 50 days or 60. And I'm like, well, we did have a good 2 weeks in there that was kind of a waste of time. So so we can move, and we push on both ends. We'll try to push the borrowers to get things to us, and we will push the lenders. And the lenders are bankers, and they work bankers hours, and that drives me crazy sometimes. But you see it's 7:30 at night here Eastern time, and we're working, and I'll be working at 10 tonight. So the bankers hours kind of drive me crazy, but we're always ready to work and things, and we're pushing on both ends for you guys to get things done. So, but these are currently the best rates and terms you're going to get as far as for funding apartments. 4.75% to 7%, 75 to 80% loan to value, 75 on the Fannie side, 80% on the Freddie side. And these Freddie and Fannie deals are really, they say they're fluid. There's a lot of different ways to put these deals together. Term lengths from 3 to 30 years. The 30-year, they're amortized 30 years, but I see the question, what determines Fannie or Freddie? They each have their things that they like to lend on. If it's just a basic apartment with you're looking at just your basic C, B class apartment, I'll usually go to Freddie. If it has anything attached to it, as far as maybe a storefront, or some of the newer apartments that have you know, the commercial on the first floor, and they got the real nice, expensive apartments on the top. A lot of times Freddie likes to deal with those. Fannie don't like the mixed use as much. There's just all kinds of different things that each of them like and that they don't like. So, you know, when the deal comes, I can't say there's really one thing that divides the two, but you know, generally I'll take it in, and my, you know, my Fannie and Freddie guy that I deal with most of the time, I'll say, hey, what do you think of this? And he usually will tell me where he thinks it should go. But there's no general rule that says one over the other. But you know, 1.5 million and up. Like I said, this is fluid. If you get a deal that the loan amount comes out around the million mark, we can still probably get it done through an agency if it is a nice asset. You know, so if you got $1 million loan amount on a 30 unit, you know, that's probably not a real nice asset. If you got a $1 million mark, you know, I should have said these loans are for properties 5 units and above. That's multifamily. We can lend on 1 to 4s, but that's not in. I mean, that's not any of these programs we're going to talk about today. But if you're looking at a 5 unit that your loan amount's $1 million, that's probably a pretty nice asset in a nice area, and it's one that we could probably get done through an agency because it's a nicer asset. The DSCR, a 1.2 minimum. You know, if you're coming in, and you know, this program also has interest only periods, but if you're coming in looking for interest only, figure your DSCR, you're going to want it to be 1.3 to 1.4, maybe even 1.5, to really be able to get a deal done and be able to qualify for the you know, the property for interest only. Go ahead and next page. So HUD and FHA, I just want to let y'all know this one's out here. This program here is for investors generally that are very experienced, because and not because it's a program that needs experience, but because it's the program that has so much paperwork and things like that to come along with it. When you're applying for a HUD or FHA loan, you're going to take probably a year to close this loan. If you're lucky, it'll take a year, and all the regulation and all of the different things that you'll have to go through to get this loan closed. Most people that get these loans closed hire somebody full time as a compliance officer to do nothing but compliance for the government paperwork and things that'll need to be done to get these deals done. But you can see, you know, when you're looking at the, I can't see the screen. Something happened on your end there. It's like doubled up or something. There it is. That's better. So you can see it's another government program. The interest rates can be really good, up to 90% loan to value. And you can amortize these loans up to 45 years. Minimum loan amount there is 2 million, and you can do if the property cash flows even, so a 1-to-1 DSCR, they will close a HUD or FHA loan on that. You know, but like I said, very stringent. If you come into one of these, going to do construction, they do ground up construction on these. They do you know, big heavy rehab, all that with these loans. But when you do a HUD or FHA loan, you know, you have contractors doing the work, they all have to comply as well with government wages, prevailing wage, and all those types of things as well. So that's where you come in, and you've got to hire somebody to just take care of that end of the job. So it's more than most new investors can handle. So I see somebody asked, which are the best to assume? you know, I'll talk about the assumables here towards the end. Go ahead and scroll to the next one here.
Oh, we got a question, Robert.
Okay.
Yes, for the HUD loans, do those
Yeah.
require a certain percentage of the units to be subsidized, or is that a separate HUD program?
You know, they usually come along with that. So if you're doing one, you can do some really nice apartments, but generally there will be some kind of a breakdown. And I think I'm not 100% sure, but I think that's kind of state by state on how they want the breakdown.
Okay,
We've not done any of these HUD loans, you know, and I will work on them, but I'm not like super excited to work on one for a year, you know, because
my team's not doing
we
subsidized properties either, so I
yeah
hear what you're saying, but I was just curious if that was
yeah
like a standard requirement where 35%
you know
subsidized, because I've run into a few properties like that. But yeah, thank you.
yeah
We have another
yeah
question.
generally okay. Well, I will tell you guys on the HUD, we're doing a big government housing project in Cincinnati right now through our construction business, and we're having to pay government wages on this, and it's kind of a pain in the neck to do. Just on as a contractor, if you're expecting to do one of these loans and you're hiring contractors, expect to pay 20% more just for the paperwork in that they're going to have to do. So, and who's the next question?
We have Alicia. Alicia, you can go ahead and unmute.
Alicia.
Yes,
Yeah, go
hi.
ahead.
Thank you so much for your time and for doing this.
Yeah.
I was wondering with the 5 to 50 unit goal, if our buy box is currently higher than 50 units, should we consider adjusting or?
I wouldn't. I would just, you know, if you happen to have one that you were looking at, or you know, something along those lines, I would say, you know, now would be a good time to do it if you were ever going to. You know, just when they say that's what they're looking to fund, you know, you're going to get the best rates and terms. That's just, you know, I wouldn't necessarily change your business plan because of that. I'm just letting people know because that's the information I got. So,
Mhm. Thanks.
yep. Yeah, no
Got one
problem.
more question. Time for one more question.
Okay. Yeah.
Jonathan.
Oh.
Is Jonathan there? There he is. Oh. Go ahead, Jonathan. Can't hear you. There
Can
you
you hear
go.
me now?
Yeah.
Yeah.
Okay, it's saying I'm not even, it's saying there's no sound, so sorry. Anyhow,
Okay.
hey guys, by the way, Jerry, thank you for this morning. Appreciate it. What
Yeah.
I wanted to know was, so you gave this range of like 4 point something to 7 point something. And then you also mentioned that it's for, you know, I don't know what the term you used, prime properties or whatever. So two things. One, can you please characterize like what the, you know, like what you need to get that low one, you know, for the most years, and what you would be getting if you ended up with the higher one with less years. And then with regards to the what was the other question I had? With regards to, what was the other thing I mentioned, guys? Prime. What is prime? What is prime? So what if the location is
Yeah.
prime, but it doesn't have the number of units?
Well, I mean, you know, if you're 5 or more units, you know, that's the requirement as far as units on, you know, for the agency debt. If it's less than that, I mean, then we just have to go with a different program. But you know, as far as the best rates and terms, the better DSCRs will get you better rates and terms. the very, very nice assets, the A-class assets, B+, A-class assets will get you the best rates and terms. Also, you know, the agency debt with Freddie and Fannie, they like the really nice assets, but they also like the, you know, subsidized properties, you know, because it's the guaranteed rent. So that you'll get a little bit better rates and things with those as well. Kind of the middle there, you know, the C's to B's are the ones that you're not going to get like prime pricing on. And, you know, and the way they, I mean, the way they do it is, you know, they look at what has the, you know, the highest default rates. And that's what they go off of on all these programs is what has the highest defaults and what, you know, what can we lend with the best terms and rates, you know, to kind of even our numbers out, you know. So when they're looking at the A-class properties, through COVID, A-class properties had like less than 1% of the tenants that didn't pay during COVID. When you go to the C-class properties, a lot of people were reporting 10 to 20% that didn't pay during COVID. You know, and so that really puts a strain onto your pocketbook as you're trying to run a business, you know. And because of these things, I mean, these programs are smart, you know, and because of these things, they are, you know, that's why their numbers come in the way they do. So.
So, but I mean, like, it's odd because the Class A buildings, I mean, you'd be looking for this kind of small loan for something that would cost an immense amount. So I guess they are just trying to loan a very little bit. Isn't that right?
Oh, no. I mean, you know, through the, you know, Freddie and Fannie, I mean, they'll lend, you know, over 100 million. So, I mean, it's what I was talking about before was the small balance programs. They have the conventional programs that go up to 100 million as well. So,
Okay.
yeah. So the nicer assets get the best rates and terms, or if they, you know, like I said, they're government program and they're mission driven to provide affordable housing as well. So when you get the government subsidized, when you can prove that your rents are below average for the area, there's all kinds of different formulas to use to try to get better rates on these loans. So, and
So
there's
you said
not
it took
any
a
that
year
are,
too, right, Jerry? Took a year?
I'm sorry.
It took
No,
a
that
year?
with HUD FHA, these will take a year to close. With
Okay.
the last slide, the Freddie and Fannie,
Mhm.
you know, those 60 days.
Okay,
So,
cool.
yep. So go ahead and move on past the HUD. CMBS, I'm gonna quit taking questions here for a few minutes, and we'll slide on through these and get done. And we'll get to the question and answer time. So, CMBS loans are commercial backed securities. They take these, you know, and they actually sell groups of these loans, you know, in the stock market, and they, you know, it's a way for the stock market to get involved. You know, interest rates 5 to 8.5, loan to values 75%. You know, these are amortized 20, 25, and 30 years, $1 million minimum, and the DSCRs, you know, 1.2 or better. You know, if somebody comes to me and you have a storage unit or you have a hotel, usually a flagged hotel like you know, that has a big name on it like Hilton or you know, one of those, you know, Dollar Tree or one of the popular names, I would take that deal to a CMBS. Generally not apartments. That's just they're not as good on apartments as like Freddie and Fannie are. Go ahead and move on to the next slide. Banks and credit unions, you know, they can be a really good friend to an investor, but banks also can be really it can be really hard to find one. that likes dealing with investors. But you do find a bank or a credit union that likes dealing with investors. I would say try to do some business with them. Every bank that does loans for investors, I mean, they will all sit there and tell you that they do loans for investors. But when you're looking at like Chase, or you're looking at a Fifth Third, which we have here, I don't know what banks you have locally, but the bigger banks, if you go in trying to buy a 5, 10, $20 million deal, they're gonna send you down the road, because the big guys, Wells Fargo, Chase, all these guys are wanting to lend on the really big stuff. 50 million, 100 million plus. You find some smaller community banks. Chances are you'll find some, but they all have their own niches, however you say that. You'll find some that just like to lend on hotels, some that might only want to lend on shopping centers. Every one of them's different, and there's so many different things that they like. I don't want to spend too much time on it. But if you have a banking relationship, I'd ask them what they do and what their niche is. And then come back to us, and we can give you better rates and terms. But anyway, no, that a relationship with a small bank or credit union can be very beneficial. As far as a lot of different properties that don't qualify for our programs, you might be able to find a good bank that'll qualify them and be able to get you funded for them. So go ahead and move on to the next. Bridge lenders. Bridge lenders are private. You might find some banks and credit unions that'll do them, but most of these other loans that we talked about there's all a market for them once they leave the mortgage company that provided the loan. It's just like when you have your home mortgage, and as soon as you get your home mortgage with a certain company, they sell it, and then they sell it to somebody else, and there's a market for it in a secondary, and they sell them. But the bridge loans are short-term loans. They'll stay with the same place. 6 months to 3 years, interest only, usually simple interest. So if you borrow $100,000 or $1 million, and you're at 10%, it's going to be a $10,000 or $100,000 that you got to pay back through a year, however long the term for a year. So if it's a 6-month loan, you'd be, half of that. If you're 3 years, you'd end up on $100,000, you'd pay 30,000 in interest on a 10%, on 10%. But the biggest thing that bridge lenders look for, they're not looking at DSCR. They're not looking at all these things. They're looking at what the DSCR can be, because they know that there needs to be an exit strategy for whatever project you're working on. People might do a bridge loan to do construction, or they might do a bridge loan because it's a new build that they're buying from someone, and they're wanting to eventually finance into an agency loan. But to finance into an agency loan, you need 90% occupancy for 3 months or more. And you don't have that yet. So you might do a 6-month or a year-long bridge loan, just to bridge that gap until you can qualify for the long-term agency debt, or whatever it is you're trying to do, or, maybe get to that point and then turn around and sell, whatever it is. But bridge lenders want to see an exit strategy. And I will say because the market's been so, trying to think of the right word, it's been a little volatile. There's nobody can sit and tell you that next year it's going to be like this. Bridge lenders have really tightened up, where they used to lend, 70, 80%, 60 to 80%. Lately I've been seeing 50 to 65%, when I'm getting quotes and things on them. So just know that they're trying to cover themselves, and them covering themselves is probably going to cover you as well. So if they're not willing to lend on it, and a lot of these bridge lenders, they'll look at the deal and say, okay, if this deal falls through and the borrower, can't follow through with what they planned, do I want this property? And am I going to be able to get my money back out of this property at the end of this if it doesn't work out? And there's some of them that look at them like that. And there's some of them that don't never want to do that. So they're going to be a little more conservative and say, hey, if this doesn't have an exit strategy, we're not doing it, So go ahead to the next one. Private lenders, they each, there's a bunch of them out there. When your deals don't fit the other boxes like CMBS or, when you're looking at the agency debt, maybe it don't fit for your bank. Private lenders are the way to go. Each one has their own things they like to lend on. There's some, I've actually got some lenders that don't lend under 50 million, and these are private lenders. And one of them told me when I met them, they said, we'll lend down to 50 million, but we need to know that their next deal is going to be 100 million plus, or we're not going to mess with them. And then we've got other private lenders that lend, 100,000 to $1 million. So it's a mixed bag, and they'll lend on just about every asset class, depending on the lender. When you come to us, we have a lot of different options in this arena. Like I said before, from the 1 to 4 units to, when you're dealing with single family to 4 family rentals and rehabs and all them, all the way up. One of our lenders over the summer closed a deal in Dubai for $2 billion. So we can kind of hit everything all the way through. If it's real estate related, commercial real estate related, we can find a place for it if it has a place. So going to the next slide. And so somebody asked earlier, what do we need and when do we want to be involved in it? You can kind of give yourself soft quotes on things like if you look back at those the one slide we showed with the agency debt rates and stuff. You can look at those, or you can always feel free to give me a call if you have a deal you want me to look at for you. It'll be a quick look. I need T12s, rent rolls, and OM. Before we could go and get you a hard quote from the lender and get you something locked in. And a summary of what you're planning to do with the property as well. I want to know, kind of what you come up with on it before you send it to me. I want to see, kind of what you come up with as far as NOI and those types of things. But before we can really go under like it's an LOI that our lender will submit for you. Before we can go that far in the deal and I can really get hard quotes and get you locked into rates, I'm going to need an SREO or schedule of real estate owned and a PFS, which is personal financial statement. So some of you guys might have that stuff already. Any of these programs that we looked at, the general rule of thumb is if you are getting ready to finance $2 million, you're buying a property for 3, you're going to finance through us $2 million of it. You're going to have a net worth equal to or greater than the loan amount. So that $2 million is where the net worth needs to be. And the cool thing about being on here and a part of the Freedom Chasers community is that does not have to be your own net worth. It can be combined with a couple different people, or what a lot of people do. And there's a lot of people out there who have bought a lot of properties, and now all they do is they sign on debt for people that are trying to get a start. They call that, your sponsor or your key partner, key principal. And they will sign on as the person has the net worth to be able to close the deal. You know, and so they look at that net worth through the PFS, and they also want to see some experience. So your schedule of real estate owned. So those are the things that we need: OM, rent roll T12, and what you plan to do with the property. You know, I have people that'll send just an OM sometimes, and I'm looking at it, and the OM really doesn't. I mean, I've quoted them off of those before, but I really need to see all those things and kind of your plan for the property. That helps me to be able to know what I need to quote for you. So, I hope this was valuable to everybody. But go ahead and you can raise your digital hands and start firing some questions away, guys. I'm ready. All right. I see Edward on there first. Go ahead. Go ahead, Edward.
Yes, sir. I do have a quick question. So what are the requirements for a construction loan, or maybe a rehab, or if somebody need money to rehab, let's say a multifamily?
Yeah, the requirements are different when you're talking 1 to 4 units than if you're looking at something bigger than 4, like 5 or more units. Experience is going to be a lot more important. Experience of, you know, they're going to want to know how many properties have you rehabbed in the last 3 years. They're going to want to know these things. You know, so let's say you've done, you know, 4 fix and flips over the last 3 years or 2 years or whatever. Chances are, if you're going in and you're trying to do a 6 to 12 unit property, you know, you're going to you know, you're going to be able to do that if you have some experience and you also have a lot of cash to bring in the deal. So if you're after rehab value, let's just use kind of you know, you're in the Cincinnati market here like I am, Edward. So just, you know, 12 unit property is, you know, you're buying it rehab, it's 700,000. You'll probably be able to fund, you know, 350 to 450,000. You're going to have to bring the rest in cash. And, you know, that property might be worth $1 million when you're done, you know. That's kind of where you're going to be until you get some more experience with bigger and bigger properties. Then you'll be able to get to more of the 80% loan to cost and things like that. So,
Oh, thank you.
yeah, no problem. But yeah, experience now in this market, experience on anything that has construction related things to it. If you're buying a property for 500,000 and it needs 600,000 in work, if that construction is higher cost than the property itself, we're going to have a hard time finding somebody to do that deal. And you know, it just, the risk factor for the lenders goes way up. So, you know, just to keep that in mind. And also your per unit price. I found that if your per unit price, when you're purchasing, even a rehab, you kind of want that per unit price, you know, over 50, 60,000 would kind of be your minimum you'd want to look at. The lenders like to see a bigger per unit price on those as well. So, all right. William Otis. Hey, how's it going, William?
Jerry, how you doing, man?
Good. Good to see you.
You too, brother. I'm actually up here in Cincinnati area today in Florence, Kentucky, so I'm just probably right
Oh,
down the
awesome.
road from you guys. Yeah, man. But
Yeah.
hey, I just had a quick question. Kind of around creative financing and like seller's credits and how that impacts a loan. I don't know how a lender would look at that. I'm assuming that the DSCR would still have to support the full purchase price amount. And then of course that seller credit would then come off the purchase price. But I was just wondering if you could maybe help explain a little bit, or how you
Okay.
would look at
So
that.
you're talking like if the seller's offering some money to help with your down payment and things, is that what you're talking about?
Correct. Yeah. So let's say, for instance, we're trying to get into a property at 63,000 a unit, 62,000 a unit. Maybe we give them 64 to 65, but then they're giving us the seller credit to get us essentially back down to that purchase price. Does that make sense?
Yeah, yeah. I mean, the lenders will dissect everything you're doing. If you're, getting money from the seller, if you're, they want to see somebody with some skin in the game. Um, so if it's a seller, you know, that's usually not a problem. They won't allow you to like, do if they're needing 30% down, they won't allow the seller to usually, put all 30%, the purchaser or his investors or somebody's going to have to put some cash in. And that just keeps you from just being able to just walk away from the deal. And they're always looking for that. And every lender is different. And in this market, when you're looking at little things like that, bring it to us and let's go to talk to the guy that's actually lending the money on it and their legal team and all that, and make sure that everything we're doing is legal and able to get
Great.
things closed.
Okay, perfect, man.
Yeah, skin in the game is big. And I have people calling me all the time for, hey, I've got this guy doing owner financing and I need another 30% to put down. Well, at that point, the guy that's buying it doesn't have any skin in the game. And it's pretty much like the guy that's selling a property. It's almost like he's doing a refinance, and just getting some debt on his property that sometimes is paid for. And it just, those deals don't work. Those like that, there needs to be some skin in the game by the buyer. That seller isn't going to give control over to the property to a guy, and then now have a mortgage on the property as well. That it's just, when you're looking at these, look at it from the lender's perspective and say, hey, if I had a 20 million bucks that was at my discretion, would I do this?
Right.
And it's good.
Sorry to interrupt you. Yeah, to add a little more color to it too. Really what we're looking to do with it is to essentially fund the CapEx for the property. So we would still be putting up our money, but the seller credit would be essentially for the CapEx.
Okay. Yeah. Yeah. That kind of stuff's no problem.
Okay, cool.
I got a question.
Thanks, Jerry.
Yeah.
Someone asked,
Yeah.
what is a T12? So I want you to go ahead and explain that, and what to
Okay.
do if the broker/seller doesn't have one. It's a great question.
Yeah. The T12 is your trailing 12 of expenses and income. So it's an expense report from the property. When we're looking at it for agency debt, sometimes like we'll look at a T12 and the agency debt, they will underwrite the last 3 months. So if the income has been kind of gradually going up over the 12 months, we can underwrite and get the NOI for the last 3 months, and then we can take and take that last 3 months, multiply it by 4, and we got a year's worth of what the next 12 months should be, right? And we can get you a little bit better loan to value sometimes on a deal like that. But coming back to the question was, what do you do when the seller doesn't have one? Tell them to write one out for you. I mean, join these napkin underwriting calls, and they're going to underwrite and they're not going to look at the T12. So when you're looking at the expenses of a property, you got 10 units, figure out what the average rent is. And then from there, take what, kind of go through the whole process of the napkin underwriting, and you can kind of do it on your own. But when the lender comes in and they start looking at it, if we have a property that we have no way of verifying income and expenses, that is a property that could not get funded through an agency loan. It would have to go to a private lender. It'd have to go to a private lender, possibly even just do a bridge loan for a year. And then you can keep track of expenses for a year and refinance that down into a better rate and term and a longer term loan. But I will say, if you're running into a situation like that, take advantage of, I mean, not take advantage of people, but, you know, take advantage of the fact that I'm going to have to get work. My debt isn't going to be as good on this deal because this guy wasn't organized. So because he's not organized, I'm not going to pay him as much for his property. You know, and I remember somebody asked about assumable debt. You know, and I want to, you know, there's a lot of assumable mortgages and things being advertised out there on properties. The first thing, yeah, well, be leery of those deals. I mean, you know, assumable deals can be done and all that, but don't go into a deal and pay more because the debt is better. Because you're going to eventually have to get out of that deal, and there's no guarantees that debt is going to get back to those rates. And so now you're buying a property at 10 million and today's value is 7 million because they offered their mortgage to you. I would still pay that 7 million for it today. It just, you know, because at some point you're going to have to get out of the property yourself, right? I mean, or that's the plan. So, or at some point that loan's going to come mature and you're going to have to refinance, and you want to be able to refinance the property without pulling money out of your pocket to refinance it. So be very careful and don't overpay for things just because someone offered you a loan with a 3% rate or a 3.5% rate. You know, if you can get that and it's good terms and you're not overpaying for the property, do it all day. But there's a reason these people are selling right now. You know, and why are they selling a property that has a 3.5% rate that's cash flowing? Well, there wouldn't be no reason. I mean, if it's cash flowing, it's got a 3.5% rate or whatever it is, you know, there's you know, it's just it's got to make sense. And overpaying for something because you're getting a better rate, that just don't make sense to me. So, I mean, if you want to do it, go ahead and, you know, I'd say feel free, but, you know, enter at your own risk. So,
I got another question.
anybody else have any
Yeah.
questions? Go ahead.
I do.
Yeah.
Marcy said, what is a good way or format that you like for your experience resume?
You know, tell about yourself, you know, whatever professional experience you have in things, whatever real estate experience you have, if you have any, if you've taken courses. I mean, if the only thing that you have on there is you've taken some courses and things, I would put those on there. But maybe if you don't have any yet, you know, if you don't have any, like if you have never bought a, you know, single family or anything, you probably just need to find someone that has done those things and use their resume, you know, put in some more work with them. And then when you do the work with them, then you can put it on your resume, what you did with them. And then
Well,
you
see,
have someone you're,
I
Yeah.
sell manufactured and modular homes to parks and to private land, people who put it on their private land. And so,
Okay.
and then I supervise the setting of the house, but I don't know how to put it on a nice format that isn't too much, too little, that gets right to the point of what you need.
Yeah. Yeah. So, I mean, you know, you can do it in a page, you know, I'm so-and-so, you know, and this is my business, this is what I've been doing for X amount of years. Our new business is this is what we plan to do, and talk about the things that you're doing, and even
Right.
talk about some of your partners. You know, if you have a partner that you're buying, you were the one talked about, your,
Mobile home parks, and he's owned
yeah,
parks before.
yeah. So if he's got some experience, you know, and you get him to make a resume as well. And then when you guys turn in resumes, turn them in together.
Well, they're asking for that. They're asking for the purchase agreement, telling us about what we do, what our experiences is and our plan. I just don't know quite, I've never put one.
Yeah. You know, I see a lot of them, but I mean, I would like to say I have one. I don't want to give anybody's to you to look at. But you could probably just Google it and say, business experience resume and just
Okay, so just
type it into
something that
Google.
simple.
Yeah. Yeah. Just something simple and see what other people have written and what's on Google. I mean, most of them I'll get some that are real fancy sometimes that have, 15, 16 pages, but usually it's just 1 or 2 pages.
Is that the one you read the most?
I just put
Yeah, I
mine
mean,
in there if you guys want to see mine. I stole it
Yeah.
from what's his name? Setwanian, what's his name? The guy that's the guy that's been with Sub2 for a while. He did a presentation and I just took his deck
Okay.
and I made my own. So you can
Where did you put that?
It's in the
It's
chat.
in the chat here.
All right, thank you.
Awesome. Thanks, Jonathan. Hey, ask and you shall receive, huh?
I got another question.
Okay.
Let me find it here. From a lender's perspective, does the MSA where your current properties are located play a big factor if you're buying multifamily units in a new market? Does it qualify as experience?
It qualifies as experience, but the lender's going to get nosy and want to know who your new property manager is going to be. So yeah, having experience is experience. So just because it's in a different area, they're because of that, they're going to be like, hey, who's your lender or who's your property manager in this new area? And they're going to want to know. They might underwrite the property manager a little bit before they lend the money on the deal. So.
All right, let's move on here.
All right. Yeah. The next Zoom, February 8th, we're going to skip next week. And at some point, we're going to start doing them every week. But right now, it's every other week. Probably towards the end of February, we might get started doing every weeks. But the next one is understanding DSCR. I have a lot of people that in a lot of deals I look at the, DSCR is what is the factor that tells how much can be lent on the property, and a lot of people I've run into, don't understand what that means. But when I'm showing on the slides, that Freddie and Fannie will lend up to 75 or 80% loan to value, that doesn't happen much anymore. Because of the interest rates, the debt has gone up and the expense of debt has gone up so much. The DSCRs don't work. And so we're stuck, at 65, 70% loan to value on a lot of deals because of the DSCR. So we're just going to dig in more on how to figure DSCR, what it means, what it does, and all that. So every single commercial real estate deal that is ever done, besides the bridge loans, are done based on DSCR. So when you go to buy a home, they look at debt to income ratios. When you go to buy commercial real estate, they look at DSCR. And so we're going to talk about that on our next one. And so it's been great to have everybody here. I want to push the multifamily freedom chasers community some more. Get on those Sunday 8:30, Monday at 2, Tuesday at 8, and every other Wednesday at 7. You've got us. So
Just share the link in the chat.
Yep, Shelly shared the link. And just once again, here's our contact info. Feel free to reach out to us, and we look forward to hearing from everybody. And I hope this was valuable information. Let us know if there's anything else that you guys would like to hear about or a new topic. So
Yeah,
God
go
bless
ahead
you
and put
all.
in the chat if you have anything you guys want to hear us talk about. We'll kind of put something together. If you like what we're doing, just let us know.
So, all right, go ahead and
Hey guys,
yeah.
one last thing is if you want, I love doing diagrams. They help me. And if it helps you communicate the stuff better, I'll be happy to do some diagrams for you. If you look in sub 2, you'll see some of them that I've done. It takes complex stuff and makes it really easy to understand. And so if you decide that you want me to do it, I'm offering myself to do diagrams related to lending.
Oh, okay, cool.
Thanks.
Yeah. We can, are you able to send me a link to some of that stuff?
Yeah, I'll show you one that I did that was kind of like, it puts the entire creative finance process on a diagram with different lending options. So I'll send you that. I'll send it, Jerry, I'll send it to you. I got your email.
Awesome. Thanks. Does
Sounds
Edward
good,
have a
John.
question? I see his hands up. Pastor
Edward.
Edward.
No. Sorry, I forgot to
You are fine.
turn it down. Yeah.
Okay,
Sorry, let me
good.
do it.
I am
Yeah.
going to play some music here. Hope you guys enjoyed the Zoom, and I hope you guys enjoy this music. Listen to the words. Are you hearing it?
Nope.
Can you hear it now? Thank you.
When Jesus says yes, nobody can say no. When Jesus says yes, nobody can say no. I'm not worried about a thing, 'cause I know you are guiding me. Where you lead me, Lord, I will go. I have no fear, 'cause I know who's in control. There's no limit to what you can do, 'cause it all belongs to you. Yes, it all
Feel free
belongs
to
to
reach
you.
out to us whenever you guys want. You have our phone number.
All belongs to you. Yes, it all belongs to you. When Jesus says yes, nobody can say no. When
Feel
Jesus
free to dance too
says
if you
yes,
want.
nobody can say no. When Jesus says yes, nobody can say no. When Jesus says yes, nobody can say no. I'm not worried about a thing,
Is everybody
'cause I
hearing me?
know you are guiding me. Where you lead me, Lord, I will go. I have no fear, 'cause I know who's in control. There's no limit to what you can do, 'cause it all belongs to you. Yes, it all belongs to you. You're almighty and all powerful, and it all belongs to you. Yes, it all belongs to you. When Jesus says
Thank you guys. We enjoy having everybody on here.
Jesus say yes, nobody can say no. When Jesus say yes, nobody can say no. When Jesus say